Hello, Senior Fives. Welcome you to Term 2. This is going to be, again, another amazing time that you are going to interact. Remember, we completed Term 1 by discussing part of financial institutions as our unit. So we are going to continue. Remember, we ended with the central bank. We had discussed what it is, some of its functions. So we are going to continue to look at another component under the central bank, and this is the monetary policy and the monetary tools. The word monetary policy, first of all, it comes from the word monetary, which means cash or which means money, and then a policy is like a set of rules that is set up to regulate a given situation or activity or something that is intended for the general good. So generally speaking, the monetary policy refers to the measures used by the central bank to control the demand and supply of money together with the interest rates in order to influence the level of economic activity in the country. So generally, the monetary policy, there are the different tools or measures that the central bank, and then we know very well that the central bank in Rwanda is the National Bank of Rwanda. The measures it uses to ensure that the money circulating in the economy is regulated, and the interest rates at which commercial banks or other financial institutions lend credit to the public are regulated. So the aims of the monetary policy may include we have to maintain domestic price stability in the economy. One of the primary functions of the National Bank of Rwanda is to maintain price stability in Rwanda. So one of the aims of it implementing monetary policy is actually to achieve its cardinal goal of price stability in the economy. The next aim we can talk about is to stimulate economic growth and development. Another aim is to ensure equitable income distribution. We have to help to achieve full employment of resources in the economy, to maintain a stable foreign exchange rate. So those we are going to look at others, but generally these are some of them. To continue with the aims and objectives of the monetary policy, we have to ensure balanced, sustainable growth and development of the economy. So the National Bank, or through the implementation of the monetary policy, ensures that there is balanced growth and also sustainable development in the country. Another one is to create a broad and continuous market for government securities. We all know that government lends or borrows funds from the public through the sale of bonds and treasury bills. So it's the responsibility of the National Bank or through the monetary policy to ensure that this happens. We have to help establish and develop financial institutions. The monetary policy aims at promoting financial soundness and in financial inclusion, so that now each and every sector and individuals in the country find themselves as active participants in the financial systems that take place in the country. We have to ensure balance of payment stability in the economy. We shall have to discuss what balance of payment stability means, to ensure savings through the manipulation of the interest rate, or to encourage savings through the manipulation of the interest rate. So the monetary policy aims at promoting savings through manipulation of interest rates. So now we are going to talk about what we call monetary tools or instruments of monetary policy. So generally, monetary policy refers to like we said, the measures that the government or the central bank use to regulate the amount of money circulating in the economy and the interest rates. So if government want to regulate money supply and interest rates in the economy, what does it use? So these are the tools or instruments we are going to talk about. There are several, but we shall be discussing them one by one. So what we can say before we go to the examples of monetary tools is that we have two ways. So we have what we call an expansionary monetary policy, and then we have the contractionary monetary policy. If government wants to increase the money supply, then to use what we call the expansionary monetary policy. And if government or the central bank wishes to reduce the money supply, it adopts the contractionary monetary policies. So the nature of policy used depends on the situation at hand. So for example, if there is inflation or if there is excessive supply of money in the economy, then a contractionary policy is adopted and in other words, if there is a deflation or if prices are low due to insufficient money supply, then the government will adopt an expansionary monetary policy to increase the money supply. Okay, so let's continue to discuss the examples of these monetary tools or monetary policies. So different instruments or tools are adopted by the central bank to control money supply and to control credit. So examples include bank rate, open market operation, reserve requirement, selective credit control, margin requirement, moral suasion, special deposits, and currency reforms. Let's try to analyze these monetary tools. So you're going to begin with what you call the bank rate or the discount rate. The bank rate is the rate at which the central bank advances money to commercial banks whose reserves are temporarily below the required level. So there's a situation where the central bank are forced to go and borrow money from the central bank. We discussed among the functions of the central bank, we said it is the lender of last resort. So if commercial banks run out of cash, they can go and borrow temporarily from the central bank. So the interest that the central bank charges commercial banks when it lends them as the lender of last resort, we call it the bank rate. So how does it work? So if the central bank wishes to increase money supply, then it lowers the bank rate such that commercial banks find it attractive and easy to borrow money and also lend it to the public at a low interest. However, if the central bank wants to adopt a contractionary policy, then it will increase the bank rate such that it reduces the ability of commercial banks to lend when it charges the commercial banks a high interest rate. So if it wants to increase money supply, then we call it an expansionary. Then when you want to reduce money supply, we call it contractionary. So it uses the same tool either way. Then there's the second one is what we call the open market operation. So this is very common, and the National Bank of Rwanda does this, and it is through selling government securities or treasury bills as commonly known, or bonds. So if government wants to increase money supply, it will buy back the bonds or securities that it sold to the members of the public. And if the central bank or government wants to reduce money supply, or if there are some inflationary tendencies in the economy, then the central bank may sell bonds or treasury bills to the public such that it withdraws some money from circulation and then if it wishes, there are some tendencies of deflation, then government pays back people who bought bonds, and then it increases money supply. So that's how that tool operates. Let's continue by looking at what we call the legal reserve requirement. So the legal reserve requirement is the amount of money which by law is supposed to be kept by commercial banks in the central bank. So the money that commercial banks collect on a daily basis, there is a certain percentage which they must by law keep in the central bank. For instance, the central bank may have a policy that all the money collected or that the public has deposited in the commercial bank, say 5% of that money should be deposited in the central bank on the accounts of those respective commercial banks. So by taking away a certain percentage of deposits that the public has made with the commercial banks, in that case the central bank will be reducing the ability of commercial banks to lend money to the public, and then we know that lending increases money supply. So if government wishes, or if the central bank wishes to reduce money supply, it will increase the legal reserve requirement. And on the other hand, if the central bank wants to increase money in circulating into the economy, it will reduce the legal reserve requirement, or the percentage of the total bank deposits that should be deposited in the central bank by the commercial banks. That one is also another tool that the central bank uses to regulate money supply and credit creation. Then you have what we call special deposits. The central bank may require commercial banks to create special deposits over and above the legal reserve requirement. So we say that the legal reserve requirement is a percentage of total deposits that must be kept in the central bank by commercial banks on daily basis. However, if the money supply is really high, then what you call a special deposit may also be added on top of the legal reserve requirement as a way of reducing money supply. So that is done when we are experiencing inflation. Right, we still continue with discussing other tools. There's what you call moral suasion, and moral suasion is like how the central bank may persuade commercial banks to follow a desired monetary policy. So normally what happens, the central bank formally asks the commercial banks not to contract credit during inflation and to expand credit during a slump. So like what you call a desired monetary policy, like either to increase or decrease. So if there is a desire by the central bank to increase money supply, then to request commercial banks to increase credit facilities. And then if there is a sort of inflation or increase in money supply, the central bank requests commercial banks not to create credit or to reduce the amount of money they are giving out as credit. Although not backed by the law, commercial banks will always agree. So this one is like a request, it's not a command. And then the other one is what we call the selective credit control. The central bank can instruct commercial banks to favor or disfavor certain sectors of the economy in terms of credit facilities. So different activities in the economy may be given priority and others may not be given priority. So this aims at encouraging certain productive activities and discouraging others. So the central bank issues directives to commercial banks to give or not to give loans to specific activities for certain purposes. So let's take an example. Maybe government may take agriculture as a priority sector, and maybe let's say what, any other sector as not priority. So government may instruct commercial banks to give or to provide loans or create facilities to those identified sectors, and then discourage them from giving out loans to other sectors. Now we are going to look at the last two tools of monetary policy, and the first one is what we call the marginal reserve requirement. So we all know that before securing a loan, normally the person acquiring a loan should present a collateral security to the bank before the loan is given. So for example, if you're going to get a loan, they can say that you have to present a land title, the card of your vehicle, and so those are some of the examples of what you call the collateral security. So in case you fail to pay back the loan, then the bank can liquidate your property and redeem back the money. So what you call now the legal reserve requirement is the percentage of the value of, or the difference between the value of the property that you present to the bank as collateral security and the actual amount of loan that is advanced by the loan by the bank to you as a loan. So when the collateral security or when the central bank wants to increase money supply or money circulation, it sets a lower requirement for the marginal reserve, while if it wants to reduce the amount of borrowing or reduce money supply, then the central bank asks for a higher margin requirement. For example, they may move it from say 65% to say 80%. In that case, banks will be threatened to advance loans. Then there's what we call currency reform. I think you have seen that of recent, the National Bank of Rwanda has issued out some new banknotes, like the 2000, the 500. So that one we call it currency reform. So currency reform is a policy carried out when all others have failed to reduce money in circulation. Here the central bank introduces a new note or currency to replace the worn out notes or the one that has lost value. So one single note will be equal to large sums of currencies which has lost value. So people are required to take back the old notes for the new currency. So those are the tools that the central bank uses to regulate money supply and the interest rates. So you may come across others, but for now we can discuss